Enjoying a successful investment experience can be challenging for even the most astute investors. At Covenant Wealth Advisors, we believe that your success depends on many factors, including your ability to stick to time tested principles. Investment principles help set a foundation for your investment decisions going forward. Because markets can often be chaotic, having a set of principles may help you make better investment decisions when the answer isn't always black and white. So, thanks for joining us. I'm Mark Fonville, and I'm going to walk you through the 12 guiding investment principles of Covenant Wealth Advisors. Principle number one, embrace market pricing. With each trade, buyers and sellers bring new information to the market, which helps set prices. No one knows what the next bit of new information will be. The future is uncertain, but prices will adjust accordingly. This doesn't mean that a price is always right. There's no way to prove that. But investors can accept the market price as the best estimate of actual value. If you don't believe that market prices are good estimates, if you believe that the market has it wrong, so to speak, you are pitting yourself and your beliefs and hunches against the collective knowledge of all market participants. Principle number two is don't try to outguess the market. Many fund managers believe they can identify mispriced securities and convert that knowledge into higher returns. But fair market pricing works against such efforts, as indicated by the large proportion of mutual funds that have underperformed their benchmarks over time. In this chart, the light gray bars represent the number of U.S. domiciled equity and fixed income funds in operation during the past 20 years. These funds compose the beginning universe of that period. The dark gray areas show the percentage of equity and fixed income funds that survived the 20-year period. The blue and green bars show the smaller percentage of equity and fixed income funds that survived and outperformed their respective benchmarks during the period. Our research shows that over both short and long time horizons, the deck is stacked against mutual funds that attempt to outguess the market. Principle number three is to resist chasing past performance. Some investors may resort to using track records as a guide to selecting funds, reasoning that a manager's past success is likely to continue in the future. Does this assumption pay off? The research offers strong evidence to the contrary. This exhibit shows that among equity funds ranked in the top quartile based on previous 5-year returns, a minority also ranked in the top quartile of returns in the following 5-year period. A lack of persistence casts further doubt on the ability of managers to consistently gain an informational advantage on the market. Some fund managers might be better than others, but track records alone may not provide enough insight to identify management skill. Stock and bond returns contain a lot of noise, and impressive track records may result from good luck. The assumption that strong past performance will continue often proves faulty, leaving many investors disappointed. That brings us to principle number four, which is to let markets work for you. Most people look to the financial markets as their main investment avenue. And the good news is that the capital markets have rewarded long-term investors. The markets represent capitalism at work in the economy. And historically, free markets have provided a long-term return that has more than offset inflation. This is documented in the growth of wealth graph, which shows monthly performance of various indices and inflation since 1926. These indices represent different areas of the U.S. financial market, such as stocks and bonds. The data illustrates the beneficial role of stocks in creating real wealth over time. T-bills have barely covered inflation, while longer-term bonds have provided higher returns over inflation. U.S. stock returns have far exceeded inflation and significantly outperformed bonds. Another key point is that not all stocks or bonds are the same. For example, consider the performance of U.S. small cap stocks versus large cap stocks over this time period and the cumulative difference in $1 invested in each index in 1926. Keep in mind that there's risk and uncertainty in the markets. Historical results may not be repeated in the future. Nevertheless, the market is constantly pricing securities to reflect a positive expected return going forward. Otherwise, people would not invest their capital. Principle number five is to consider the drivers of returns within portfolios. We often get the question, well, if it's nearly impossible to skillfully choose individual stocks in advance outside of luck alone, and nobody can accurately and consistently time when to get in and out of the market over the long term, how can I increase the probability of getting higher expected returns in my portfolio? Principle 5 answers this question. This slide documents the frequency of positive returns or outperformance across stocks versus bonds, value companies versus growth companies, small companies versus large companies, and companies with high profitability versus low profitability over rolling periods of 1, 5, 10, and 15 years in the US stock market for as far back in time as there is available data. The observations are based on annualized returns for rolling 12-month periods. For example, January to December, February to January, March to February, etc. The total number of 12-month periods for each time frame is indicated for each chart. The results show that the stock market, value stocks, small company stocks, and high profitability stocks have outperformed relative to treasury bills, growth stocks, large company stocks, and low profitability stocks, respectively, for the rolling periods indicated. As the time frame increases from 1 to 15 years, the frequency of positive outperformance increases for stocks, value companies, small companies, and high profitability companies. Long-term investors should consider that outperformance is never guaranteed and can experience periods of negative returns in both relative and absolute terms. So why is this data important? Well, while not guaranteed, it's important because it gives us a framework to potentially increase expected returns in portfolios without trying to time the stock market or concentrate too much money in an individual position. In practice, we do this by selecting the proper amount of stock exposure for a client based upon their personal financial plan, risk tolerance, and need for income. And then we tilt or weight those stocks toward value, small, and high profitability companies. This is the empirical evidence that supports the returns and historical outperformance of small companies, value, and high profitability companies that we talked through on the previous slide. This chart documents long-term average returns for the dimensions of expected returns. The data offers evidence that the size or small versus large stocks, relative price or value versus growth stocks, and profitability dimensions have been persistent across time and pervasive across geographic locations within the US and outside of the US markets. The outperformance has appeared over many decades in the US market. Looking beyond the US markets, the outperformance has also appeared in developed ex-US and emerging markets, as identified by columns 2 and 3. The data supporting the higher expected returns, combined with a strong story about why this approach makes sense, offers greater confidence that the advantages of tilting the stock portfolios toward value companies, small companies, and high profitability companies may persist in future time periods. Principle 6 is to practice smart diversification. Many people concentrate their investments in their home stock market. They may consider their portfolio diversified when they choose a large group of US stocks or US mutual funds. In some cases, they may hold a small group of US securities and still think they are diversified when they are not. Yet, from a global perspective, limiting one's investment universe to a handful of stocks or even one stock market is really a concentrated strategy with possible risk and return implications that could negatively impact your portfolio. This slide offers a conceptual comparison of investing only in the US market as represented by the S&P 500 index and structuring a globally diversified portfolio that holds assets in markets around the world, as represented by the MSCI All Country World Index. For the global portfolio on the right, holding thousands of stocks across the world's developed and emerging markets countries broadens one's investment universe. A diversified portfolio should be structured to hold multiple asset classes that represent different market areas across the world. The seventh principle we follow is keep costs low. Mutual funds have many costs, as do stocks and what we call exchange traded funds or ETFs, all of which affect the net return to investors. One easily observable cost is the expense ratio connected to mutual funds and ETFs. Like the sticker price of a car, the expense ratio tells you a lot about what you can expect to pay for an investment strategy. Expense ratios strongly influence fund selection for many investors, and it's easy to see why. This chart illustrates the outperformance rate, or the percentage of funds that beat their category index for active equity mutual funds over the 15-year period ending December 31st, 2017, the most recent year for which we have this data. Notice that 25% of managers who had an average expense ratio of 0.83% beat their benchmark. Conversely, only 6% of managers that had an average expense ratio of 1.93% outperformed their respective benchmark. While cost isn't the only factor that influences return, the data suggests that choosing managers with low cost may help improve expected returns. Principle 8 is to manage for after tax returns. When it comes to tax efficiency, all investments are not created equal. According to Morningstar, over the 94-year period ending in 2019, investors gave up from 1 to 2 percentage points of their annual returns to taxes. That's approximately $10,000 to $20,000 per year in lost value on a hypothetical $1 million portfolio. Many investments can expose you to an unpredictable tax liability, both in timing and amount, a direct result of the structure and activity of tax inefficient investments and a lack of personalized tax strategy. Managing for after tax returns may have a positive impact on a portfolio's after tax returns, potentially resulting in more money in your portfolio. That's why at Covenant Wealth Advisors, we focus so much on tax planning and investments. Principle 9 is to avoid market timing. This chart illustrates the importance of staying invested in order to capture the equity premium, or that is, the expectation that stocks outperform bonds over the long haul, although not guaranteed. Missing out on even a few of the market's best days each year can have a significant impact on cumulative returns. For example, a hypothetical scenario where $1,000 was invested in the S&P 500 index in 1990 would have been worth $20,451 by 2020. However, if the same investor had missed just the 5 best single days of performance, the ending value would be worth $12,917. This is over a 36% drop in value. How could this happen? Well, as it turns out, some of the best performing days in the stock market often come soon after the worst performing days. If you sold out of the market after a bad day, it's very impossible you could miss a subsequent large positive day in the market. The lesson is to avoid market timing because it is extremely difficult to do consistently. Principle 10 is to manage your emotions. The 2008 to 2009 global market downturn offers an example of how the cycle of fear and greed can drive an investor's reactive decisions. Some investors fled the market in early 2009, just before the rebound began. They locked in their losses and then experienced the stress of watching the markets climb. Staying disciplined through rising and falling markets can pose a challenge, but it is crucial for long-term success. Principle 11 is to look beyond the headlines. News and financial commentary can influence people's view of investing. Without a strong investment philosophy to guide them, they also may follow the advice of friends, neighbors, or family, especially if the insight promises a fast and easy return. But growing and preserving wealth has no shortcuts. Success requires a solid investment approach, a long-term perspective, and discipline to stay the course. Finally, Principle 12 is to focus on what you can control. This is a recurring theme at Covenant Wealth Advisors and foundational to how we help clients. To have a better investment experience, people should focus on the things they can control. It starts with your advisor creating an investment and financial plan based on market principles informed by financial science and tailored to your specific needs and goals. Along the way, we can help you focus on actions that add investment value, such as managing expenses, helping to reduce taxes, maintaining broad diversification, and creating the income you need to sustain your lifestyle if and when you retire. Equally important, Covenant Wealth Advisors can provide knowledge and encouragement to help you stay disciplined through various market conditions. It all starts with a plan. Thanks so much.